And on that note, let's bring in Carey, Bank of America Securities, joining us now. How would you vote in our Twitter poll? Have we seen the best of the market for the year already?
Well, I think we were expecting coming into the year we could see a bit of a bounce given just how negative sentiment had been at the end of last year and, sort of the growing consensus view that it would be first half down, second half up. Now the recession timing has been pushed out. Our year-end target on the S&P 500 is 4,000. So, obviously not too far from where we are today. We think there is more potential downside risk. A lot of the, signposts we look at in terms of, what could signal a potential bottom in the market, haven't been hit yet. So, we think this is going to be, potentially volatile period for the market and that there's, better opportunities in spots of the market, whether it be small caps, whether it be sectors, whether it be, being an active manager and picking stocks rather than just owning the S&P 500 this year.
How would you explain the disparity, though, between your S&P target, which is more or less where we are, for argument's sake, let's just call it that, and the fact that you look for a really big decline, though, in earnings? You're at $200. That's pretty weak, all things considered.
Well, I think, look, it's half the magnitude of the typical recessionary earnings decline. So we are expecting a mild recession to begin in the second half of this year and last into early next year. Usually S&P earnings decline about 20% during an average recession. Obviously, they've declined more during some of the more severe ones. So this would be less than half of that. Obviously, there's been strength in the data, but when we look at what happened this earnings season, earnings have generally been in line to a slight miss, and that was even after earnings were cut substantially. Guidance has been weak. A lot of the measures that we look at of mentions on earnings calls have suggested some weak demand. So, we do think there's more downside risk to earnings forecasts at this point, but we're not looking for, as dramatic as what you usually see during a recession for the earnings decline.